good afternoon. So we've been conspiring here down in the front for a little while and decided that we're going to really have some fun over the next 40 minutes. So I hope you're going to join us. We are going to make this kind of interactive. So if you have questions, we want to hear those questions because it is way more interesting to know what's on your minds than it is for us to sit here and have our own little private conversation. That and the fact that there's enormous capacity and knowledge in the room, and we want to harness as much of that knowledge as we can. So thank you all for joining us. And as I say, we're gonna have a lot of fun over the next 40 minutes. The other thing I wanted to say before we get started is I'm also, notwithstanding the fun we're going to have, I'm going to be running out of here when it's over because I have to be somewhere downstairs having another conversation, and I don't like making people wait. So apologies if I just flee. Do not take it personally. Panelists, do not take it personally. This isn't a statement on how I found the conversation. So we have a great, I'm going to take a seat. We have a really interesting topic to talk about. How are the new financing models reshaping the geography of innovation in emerging markets? Let me just put a little bit of kind of context on the table. I come at this from a development perspective. That's what I used to do many, many years ago. And at some level, I'm a little skeptical. We've been talking about this for 2 decades. You know, how are we going to stimulate innovation in emerging markets? We all know there's huge potential there, but how do we actually create the systems, get around the barriers that will facilitate us actually taking advantage of the potential that exists in these countries? And so this conversation is about actually what are the new financial systems, the new models, the new mechanisms that will allow us to do that will break down existing barriers, allow greater access to capital, that will de-risk investment in some of these parts of the world. How is it shifting investment strategies for big and small organizations? What's the opportunities? What's changed and what still needs to change? So that's the full set of some of the things that we're hoping to discuss over the next 40 minutes. I have a great set of panelists. I am not going to introduce them to you because you all have the app. And if you haven't already looked, then I suggest you do so. But I want to jump straight into the conversation. So I'm actually going to start with you, Andre. Troublemaker on my immediate left. I will say Andre is the co-founder and CEO of White Oak Global Advisors. And we talked the other day. And the question I want to ask you is a very broad one, which is what is the catalyst that's driving this change and opening up, in your view, the opportunities for capital?
Thank you, Zania, and thanks for everyone attending our panel here. If you think about what people consume in products and services each year, it changes by about 25 to 30%. So just think about what coffee you're drinking, what green juice you're drinking, what stuff you put in your hair. Patrick's got some colorful socks. He probably bought that 2 years ago. So if you look around just the general consumption of product and services, it changes very frequently. And we all carry these devices. Zani's got a big one in front of her, these phones and apps and PDAs. You know, there's an advent of information at our fingertips. So when our parents were buying goods, they go to Sears or they go to a catalog. It was very mundane, but now you have thousands of choices for, I'll pick on socks again, or anything you want to consume. So there's a democratization of information, products, and services. And while you may still get a cut in your finger and use a Johnson & Johnson Band-Aid, because that's a staple product. If you see on your Instagram a new hair product that entices you, you may just on impulse buy it that second, and that group that you were buying it before just lost that business. So why is that important? Is because it really creates an opportunity for small to become big and bigger to become smaller. And that's really the catalyst for companies evolving with new products and services every single day. If you go to high school or college students today, they don't want to work at Bain or McKinsey or Morgan Stanley, etc. They want to start a company. And not all of them will be, of course, successful, but that's really the starting point of supply and demand for capital and financing. And that creates opportunities not just in the US, but on a global basis, including emerging markets. But that's probably a good starting point for us to kick off this discussion is what's causing the need for capital.
Okay, so you just asked a question and I want you to answer it before I go to Achintia. What's causing...
Yeah, so these companies need either equity or debt. They'll use either capital from their friends and family to start businesses. When you go to the banking world, my friend here, he's part of a $170 billion market cap bank a small little bank called Citibank. Citibank is not going to finance small businesses. They're just too big. It doesn't move the needle. It has a very high capital charge, their balance sheet. So what these banks like to really focus on is middle market and large cap. And so there's this void for smaller end of middle market. And that's where financing is most needed. And so that's really the opportunity to start lending institutions that are basically taking, in some cases, in most cases, equity risk, but characterizing it as debt or structured equity or structured debt, and offering an investment opportunity for people to come in getting 10 to 12% returns.
So I'm going to come back to you in a second, Andre, but I want to bring in some other people. But the question I'm going to have for you is a little controversially, thus it has always been, and so what's different now? But before I'm giving you some time to think about that. Achintia, Andre has already said you work for Citibank, big institution.
I said small.
Excuse me, my mistake.
It's all relative. What's big? It's all relative.
Give us the perspective from an established bank. How does it look from there in terms of new financing models and access and...
No, thank you, Xenia and Andre, and thanks for joining us here. Look, as banks, big established banks, we want a thriving global economy. Big part of the global thriving economy is emerging markets. And 90% of emerging market businesses are small, medium enterprises, new entrepreneurs, tea stall vendors in Africa, in India, in Mexico. And even before you get to the mid-cap, Andre, there are no venture capital. Venture capital isn't big there. Angel investing isn't big there. Credit histories don't exist. Cash flows maybe not exist. Bank accounts don't exist. So I think from an established bank perspective, we want these new financing models, whether they are AI-driven credit analysis, whether it's peer-to-peer lending, whether it's agriculture financing, which I think is huge in India and Africa and many parts of the world. And we want the entrepreneur who is going to have one shop. The definition of entrepreneurs in emerging markets can be a tea stall vendor, can be a commerce company. They have no collateral. So I think from our perspective, we would like nothing more to facilitate the companies and the new models that Vinny and Patrick and others are introducing, because it will result in the next generation of big companies, medium companies, and that's how the economy will grow. And if the economy is growing and doing well, big banks are doing well. So I think we see our role as supporting these fintechs. We have deposits of customers. We can't lend from a regulatory perspective. But these new companies, these new emerging market models, they can lend directly without credit history, without cash flows necessarily, peer-to-peer. So we are in the business of supporting these, and we would love it.
Excellent. So you've given me a beautiful segue to Wenyi. I'm going to come to you, because essentially what you're saying is we can't do it, so we need these more flexible, more agile, new venture capitalists and others to step in. So Wenyi, give us, make this a little bit tangible for us, because this is a theoretical conversation thus far. What are you actually doing? What are you seeing? And why is it that you can do it now when you couldn't do it before?
Let me give you a couple of examples of companies that are in our portfolio or we're soon to be invested in. So just to get a sense of the innovations that's happening on the ground, and then I'll go to your question on why now, right? And also what are still the challenges, by the way. So one company in Polymath's portfolio, it's called Digit, and it has one product. But what that one product does is it refinances prime customers from the top 5 banks in Mexico, because in an economy that's 1.7 trillion, OECD country, $17,000 per capita GDP, Mexico does not have any offering for a prime credit card customer that is under 65% interest rate.
Yeah.
So Digit refinances those customers. There's basically no risk-based pricing for prime customers. I mean, that just doesn't make sense, right? But believe it or not, right now, I mean, I don't think it's going to be the only one, but today, Digit's the only company in the market refinancing that debt for mid-30s in terms of APR. So that's one company, and it's hard to believe that in emerging markets that type of opportunity still exists, right? Another company, right, Galgo, what they do is they finance. You're going to the other end of the spectrum. They're financing motorcycles mainly for kind of delivery drivers and so forth. So it's mostly, I would say, a working vehicle. These are definitely subprime customers, right? And so these are companies that are on a monthly basis financing thousands of motorcycles already. So starting to really grow. And I think that when I speak to international investors about a company like Galgo, I think that people are like, okay, that sounds interesting. You can make a lot of money. Your APR is at like 70-something%, but like, how big is that market? But it's just, if you've ever been to an emerging market city, you start realizing, yeah, the motorcycles outnumber the cars, right? And so I think that, and why is it happening today? I think that a lot of it is you can build these companies, especially in an equity kind of depressed environment such as today. These companies are very, very efficient. These are companies that are on a per employee basis are doing sometimes over $1 million of revenue. So how are they able to do that? So it's not that, lending is not a new business, but they're doing that because they're building the technology from scratch. They're building what could eventually be a bank from scratch, but they don't have to get there. And that using AI to do the underwriting, using AI for customer service, like the way that they, build the entire customer journey. It's so, technology is at every single phase of it, so the efficiency level is very, very high.
So if I can paraphrase, and then I'm going to come to you, Patrick. Basically, it hasn't happened before because the technology wasn't there to facilitate doing this in an efficient and financially profitable way.
I think that's true. And just to take one tiny detail on that, you're talking about inherently probably smaller loans, especially for subprime customers. So your cost of acquisition needs to be much lower in order to support that, and your servicing cost needs to be much lower for it to be profitable. So I think fundamentally technology has gotten to a point where even subprime customers can be very profitable.
Okay, so this is a story, as you've just described it, of technology in all of its facets, essentially creating efficiencies, improving access to take advantage of what is has been a market for a long time, but we haven't actually been able to realize it. Okay, Patrick, I'm coming to you because when we spoke the other day, you admitted to the fact that yes, you're in the finance space, but you spend a lot of time in the political space too and thinking about context. So I think we can all agree that we live in a very changing world right now. And so my question for you is, the changes that we're seeing in our ecosystem, in the kind of broader context, how is that affecting this question?
If I have to put things into perspective, well, this is how I think about everything. I talked about this yesterday with Eric Schmidt. We had a discussion about sort of future of collaboration. I think it's relevant here. I think for all of us and for human history, we have gone through 2 stages. We're entering the 3rd stage. The first stage until 1600, everybody is making about $500 to $900 per capita. The continent of Europe can accommodate about 60 million people. China can maximum 60 million people. 1600, what happened? And Renaissance and led to human sort of take the center stage of everything. There's invisible hand, there is industrial revolution, and we start to experience something called growth. That's linear growth per capita. Here in the US, it's about $80,000 per capita. It's a lot. But now we're entering the third phase. That third phase is the curve is this. It's no longer this. All right. So what does that mean? I have 2 kids, and so over the dinner table, and I said, all right, if you have a piece of paper A4, fold it 52 times, how far this thing goes? It goes to the moon. A piece of paper fold 52 times. All right. So this is something called exponential growth. And so we're going to see a lot of that. It's not just accelerating. I think human is good at gradual change. Human is not adapted to relentless change. So with this as a context, and certainly AI is driving a lot of change, but also on top of that, it's very complicated. We have something called geopolitics, and we have stuff like in each of the large power in the world today, you see the demographics challenge, and politics is more divided than ever. And so all of a sudden, we are actually dealing with changes in many fronts. So I think that present a modern challenge for all of us. That's called information deficit. And also, because of all this noise, and we can no longer trust the knowledge in the public domain. Media is biased, social media is self-reinforcing. When you speak in public, you're probably going to speak half the truth. All these nuances is very difficult to come through. Only when you're in a place with a few people, you probably can talk about these nuances. All right, why am I talking about this? It's because if we're talking about credit, it's all about assessing the risk first. Then you figure out what your return is. If your venture investor is about, okay, what is the upside for me? I don't think so much about risk. Risk assessment in this new world is going to be extremely challenging. So this is what we need to figure out. And by the way, people say, okay, we have this great tools like AI. By the way, the only difference between me and Wendy is I'm a bit older. And I've seen the last cycles of credit bubble in Korea, credit bubble in the US. I don't know if any of us remember the Previdian world, MBNA world. I mean, they all bragged about the technology they had, including Capital One. But they all went through a very difficult time because when the stress test comes, the model broke. That's the thing.
Okay. So I'm going to start looking out and keeping an eye on the audience, because if you have questions, I want to bring you in. If you have comments, as long as they're short ones, I want to bring you in too, because there's enormous capacity here in the room, and I want to take advantage of that. In the absence of that, I thought it was really interesting you used the word relentless, because I thought, you were talking about, I was seeing it as an S-curve or an exponential curve, and I was like, excellent, we're going to have some optimism here. This is change, this is positive, this is potential, this is growth. And then you said the word relentless, and my heart sunk. So I just have a quick question for, who sees greater upside potential than downside potential at the moment? So go on.
Xenia, I actually see more upside. And can I just say the technology point? AI is great, but it's not a new phenomenon. If you look at what Nigeria and Kenya have done, the simple unbanking sector with mobile digital lending, that started in 2007, 2008. I actually think some of those emerging market countries have done a better job. Like in the UK, in the US and Canada, I don't think there's an open banking model today. But if you look at Europe, UK, emerging markets, there's open banking, and open banking really allows you to do better credit analysis. So I'm very optimistic.
I think also
Optimistic or pessimistic first?
definitely optimistic, and not to and not to say that it's all upside,
Cautiously
right?
optimistic.
But I think for me, I mean, I come from a more entrepreneurial background myself. I'm obviously a venture capitalist. I'm also have a private credit platform. But I think for me the piece is yes, more change, but also the way to deal with that is coming more bottoms up in terms of the solution rather than top down, and more granularity and autonomy of that, right? Because the system is too complex for it to be designed and understood top down. I think that's becoming even harder. And so my point there is when even though I've been doing fintech for a long time in the same geography, the entrepreneurs still surprise me in the opportunities that they find, right? So I think there is this kind of, yes, lots of things changing, huge maelstroms, but that individual autonomy and innovation, I think, is very, very powerful when that is supported, right?
Did you want to say something?
Sure.
Always. Go on. No, because otherwise I have a question. Go ahead.
Are you going to first say optimistic or pessimistic?
Go on.
Usually I'm very optimistic, but I would say where we are in the world, I'm going to take the pessimistic camp for various reasons. Too much capital in the ecosystem. To Patrick's point, risk is completely mispriced.
Yeah.
All this phenomenon of fintech, AI, oh my God, please help me. I've spoken to so many successful entrepreneurs that have raised uber amounts of capital, and I asked them, have you ever negotiated an intercreditor? What's that? Have you ever foreclosed on a loan in English common courts, in U.S. courts, Chapter 711, assignment for benefit of creditors? What's assignment for benefit of creditors? So, look, I think there's a lot of noise in the market, and it's sexy and it's hot to say AI and fintech and efficiencies, all this stuff. What Citibank is doing is real lending. I don't know about Citibank's balance sheet, but Wells Fargo's got $2.2 trillion of loans. That's the market. That's the economy. So I think, look, I'm not discrediting any entrepreneur because I am one myself, but I would say, yes, there are inefficiencies in niche markets, and as soon as they become a little bit bigger, the big guys are going to gobble it up and issue a securitization on the paper and price the risk more appropriately and move on with life. So again, I want to not be controversial to the entrepreneurial world, but that's my viewpoint.
So look, I mean, obviously, as things become more visible, pricing will adjust, right? But at the same time, I'm talking about emerging markets. I'm talking about Latin America, which is what I know. That's very different than what's going on in the U.S. and other markets in terms of valuations and so forth. When I see these fintechs, they can probably raise the early, $2 million, $5 million of portfolio from family offices. But then,
so what's the return? What's the after management fee returns nets to investors
on the portfolio, the credit lending side? Yeah, I mean, I think it's basically low 20s.
Is that in pesos or USD?
That is in pesos.
There you go. That's your answer.
Yeah, but it also
Okay.
it's about what is the currency that they own, right? So obviously for a US dollar denominated investor, they can decide whether that's attractive or not.
That's exactly right.
But the local currency denominated investors, they will probably feel a little bit differently about that.
Fair.
Can I just put a question in here and then pick it up? Because, we've been treating the world like a unitary whole, and it just isn't. And you just kind of bringing that out. Like, it's different if you're talking about Mexico from if you're talking about the United States. You were talking about, like, you've had some experience in Asia and in India. So a question for all of you, which is, and again, feel free to weigh in if there are views out here in the audience, but from where you sit, where are you seeing the potential? Where are you seeing the greatest potential? Where are people not looking that they should be looking?
Look, I think I would go back to what Winnie is saying. We got to treat emerging markets very different from the developed markets. Like if you go to Africa, if you go to India, even the kingdom, right? I think the farmer with climate change, they don't have the money and the credit history to get a loan. So if there's a new company which is now saying, we'll give you a loan, but it's in kind. So it's not cash. You can't spend it on alcohol in India. You have to go buy seeds, and you go to repay me not in 6 months, but when the harvest comes. So it's a harvest-driven. I think that's really valuable. If you go to someone who says you don't have a credit history because you've never raised credit, but we are going to see your mobile payments and give you a micro loan, I think the impact of those microloans is huge.
Absolutely, but how is it changing? I mean, we've been having this conversation. I'm being intentionally a little bit controversial. We've been having this conversation for 3 decades. We've probably been having this conversation for 5 decades. And so my question is, what is different today, or is anything different today than it was 2 decades ago?
I'm with Vinny, technology.
I'd say information. Information is readily available in everyone's fingertips. That's the key.
And so, and that's a good thing, right?
It is. It democratizes everything. But going back to credit or equity, you're essentially taking equity risk.
Sure.
This is equity.
Absolutely.
It's not credit.
It's
And it's nothing wrong with that. Just call it whatever it is. It's equity risk.
And so, just quickly, while you've got the mic, where are you looking exactly? Where are you looking? What geographies are you looking? What sectors are you looking? Where do you think that there is potential that people aren't actually taking advantage of?
Look, we are the only emerging market country that we're focused on. We were in China. I mentioned we had a big export finance business. We had 30 people in Shanghai and Hong Kong. We couldn't compete with the Chinese banks. They crushed us, and they had some obscure government insurance company called Sinosure that would guarantee the receivables. I'm like, I'm going to knock up on Sinoshore's doors. They're going to give me my money back? Seriously? That's never going to happen. So for us, we're looking at export finance in export leading countries. Like Brazil is a great one. They export their goods to the U.S. We finance the receivables, from that area. Also, we're looking at the Gulf countries. I think Gulf, they're not all made equal. The UAE banks are flush with cash, but they're not lending to SMEs. Where there's a great opportunity in Saudi Arabia. Speaking of FII, so there's a lot of opportunities and pockets that we're looking at.
Okay, Patrick, you were going to say something.
I think it's going to get. So first of all, I think we still apply sort of old methodology to something new. This world, again, I think is going to be very different 5 years from now. Not even 10 years. 5 years from now. And look, I mean, if you're a company, you're trying to make stuff for the world, you need to export, but there's a tariff change, right? It's like that. How are you going to deal with it? I mean, how do you land? And also with technology, I mean, there's a proliferation of that with AI, and somebody is going to disrupt you, probably very quickly, with the new things you can never imagine. It's not what you know. You tend to make mistake. You make most of the mistakes where you don't know. That's the challenge, and that's where. So I think it's not about if we have AI or that kind of stuff. I think it's about you need to change the whole kind of risk assessment system, and also you have to go to the very fundamental beginning. How am I going to build a new system to collect information and assessing risk in this new context?
So, can I?
I mean, even for me, being an investor, I feel like people ask me, why you're everywhere, you travel so much. I said, this is the only way I can connect dots. Because all these nuances, if I find great people I can talk to, it helped me update my system. So my head is algorithm. That algorithm needs to be constantly updated. This is very tiring. It's difficult, but you have to do that.
Okay, you just answered my question, which is, okay, we need to find a new risk assessment. How do you do that? You travel. You're constantly out there picking up data. Wenyi?
I was going to say, I mean, I think that there's different types of ways you think about risk, right? Some of the risk is, like, I agree, things are speeding up, and 5 years, it used to be a short amount of time, and now it's a lot of time for many things to change. But if you look at loans, like obviously what that translates into is short dated loans are going to be safer than longer dated loans. It has, like, that's always been the case, but I think that starts becoming more important. So, but at the same time, I'm not traveling around the world, It, and I, but I think that there's a lot of things on the ground that's also very important for investors to understand, right? So a motorcycle loan, why does that matter? Because that allows somebody who didn't graduate high school to make 2 minimum wages, right? That's very life transforming for them. And that makes the risk, that changes the risk of that consumer. And so I think there's a lot there's a lot of things changing, but I also think, at least in the business I'm in, it's very to the ground in terms of what are people using these things to do, why do they need it, how does it change their lives, and what does that mean for the product, right?
I would just love to add on to that, and I think we can't apply global models to local countries. If you look at Singapore and Indonesia, I think they're gig economy internet companies which would give the drivers who are delivering stuff, because now they know how much money they're earning, a loan to buy the moped. So I think no one else is going to give them the loan. But Grab, for example, would have the data on how much each driver is earning, and they're going to give them a loan based on that. So I think we have to really go local. You have to work with the regulators in each region. And again, I would look to Africa and Brazil for a lot of front-leaning regulatory changes.
On the regulatory side, Brazil, going back to Brazil, one of the reasons I like the country is they got something equivalent to the Uniform Commercial Code, the UCC1 filings, where you have a lien on the asset and it's a government, stored. So you can't, very much like UCC1 in the US, you can't have 3 people have the lien on the same asset. So that's very important. These countries that you go to, you could have a loan to, I'm going to pick on motorcycle for fun, but if it's not filed and certified, you can have 3 lenders in the same motorcycle and the guy's running to the bank. So I think regulatory environment does play a very key role.
Nigeria's done a good job.
Nigeria's done an excellent job, and again, I think Brazil's done an excellent job as well.
So I mean, you just put one thing on the table that I think is really important, and really, I want to bring you guys into the conversation. I know there's expertise in this room, so please do stick your hand up, get my eye, and we'll bring you into the conversation. But you just brought up, Andre, something really important, which is, what's necessary, albeit not sufficient, to jumpstart, to transform this space. And the point I took away from what you said is a guaranteed regulatory environment or legal context. Right, you've got to have that being verifiable, etc., etc.
English common law.
English common law.
I mean, that's key.
The Brits got something right.
Can I challenge that, Andre?
They did, yeah.
You can't have English common law in Africa and India and Indonesia. Why? You're addressing global investors. Maybe this is not meant for global investors.
God bless you. I mean, that's where it gets.
I think that's why at this stage, maybe the microloans in Nigeria and Africa are not meant for the global investors. There is enough domestic liquidity, and I think what can change is regulatory frameworks will play a huge part, like interest rate caps, because what is the biggest risk here is over leverage of consumers who get easy lending and interest rate gouging.
Yeah, and I think the other piece, right, is, there's a lot that is not known. So for example, in Mexico, you can actually, as the lender, you can have title. Like you own the title of the motorcycle or whatever asset is backing it. That's better than even the US as an asset-backed lender on the back end. So
And it's Sharia compliant.
Exactly, but not really. But I think so. So I think the regulatory frameworks are just because it's outside of the U.S. does not mean, first of all, that regulatory frameworks are not there, and sometimes it's better. But the other piece of it that's really important is it's also very, very different when you think about risk of I'm lending to one company and there's one borrower on that end versus this is going to hundreds of thousands of small loans. So then the risk of that is very, very different. The pulverization of that risk is very, very different. I'm not saying there's no macro. There is macro, but the kind of like principal agent risk is very different when it's one medium-sized company versus spread out over hundreds of thousands.
So what else is necessary, albeit not sufficient? So we've said kind of the legal framework is a necessary, albeit not sufficient factor. What else is necessary?
Registration of the asset, right?
Registration of the asset, okay. What else? Oi, I've silenced them.
Well, I think the currency goes a big deal, right? So if you if you're lending in Brazil and you don't hedge your currency, which is very costly to hedge, you're going to lose all your value.
Which
I think domestic funding is going to be necessary because, again, to your point, Andre, if you keep relying on foreign investors for volatile currencies, it's not going to work.
It's not going to work, yeah.
And I think at some point you've got to rely on, if you look at the kingdom, what's the biggest difference and the advantage that the kingdom has, China has, Brazil has, India has,
yeah.
which Europe doesn't, is local liquidity, the retail disposable
Yeah,
incomes.
but the kingdom, KSA,
Yeah.
they're pegged to the dollar.
I know, but I'm just saying,
Yeah.
in terms of the local liquidity that exists,
100%.
Which
You
Europe, for
gotta
example,
you gotta raise
gotta
money
use that.
locally
You gotta-
for local investments. That makes a lot more sense. Otherwise, you're gonna
Correct.
lose your shirt on inflation and
Exactly.
hedging and all that.
I want to come back to Patrick though, because this is your area of interest. Back to my earlier question, so I'm going to basically ask the same question again, which is the context is changing. The world is changing. It's changing awfully fast. So
It's going as fast as people say.
Okay, go
it's,
on.
it's fun to talk about it. Honestly, you read AI, every single syllable is AI. I agree with Patrick. There is fundamental changes happening, but it's not as fast. I think there's more bark than bite. That's an American expression. You know those little fluffy dogs that bark a lot? They're not biting. So it's just going to take time.
that's a little controversial.
I-
Okay.
I actually would, as this might sound weird coming from a technology investor, but I agree with that because at the end, there's the application the application of AI takes a lot of tuning, thinking about it, even though, okay, everybody's talking about AI agents or how it affects your credit scoring. The way you tune that to the business model, the way you tune that throughout the customer journey for the segment that you have today, but might be different for the segment that you have in the future, that takes real time.
So I want to pick up two other things that came out, which I just think I'm just kind of, if we had a whiteboard, I'd be sticking them on the top of the whiteboard, right? And one of them is the need for local understanding. And that's clearly, local funding, but also local understanding. We were talking earlier that if you can't explain what the model of the business is to somebody, then you're not going to get any support. So, and then I'm trying to remember what the other. Yeah, go on.
So I can speak a little bit to that because I've had my fund investing in Latin America for a while, but I'm also working with a large Chinese fund that's starting to invest in Mexico. And I think one of the interesting phenomena I get is that entrepreneurs, when I'm speaking to them from a little bit more the Chinese context, and particularly in the fintech world in Latin America, there's a lot of appreciation because I would say, let's say U.S. Mexico in terms of understanding of business models, maybe it's like 10%. China's not 100%, but it's maybe like 50, 60, maybe 70 in certain industries. So that component of, I've seen this before, I think that this can work, and that goes a long way. And so I think that because I came more from the Silicon Valley perspective, and then, being on the ground for many years and now having the contract with Chinese investors, I think that demonstrates a lot what the South-South kind of connections can also do.
I want to do a little polling here because I loved your expression, Andre, more bark than bite. So hands up in the room who believe that the kind of border context, the AI, the political, the geopolitical space is more bark than bite in the context of this. Hands up.
The speed or the geopolitical?
I'm talking about kind of broadly that we sit here and we say the world is changing awfully fast and, can we keep up with it? I always loved Trudeau's quote, apologies for those who aren't a fan. The world is moving faster than it ever has before, but slower than it ever will again. So, okay, so who here believes that there's more bite than bark?
No more bark than bite.
I know, no, because we only had like 3 people stick their hand up and say more
bite.
Oh, more bite.
But, so who thinks actually there's an awful lot of bite that they're with Trudeau,
Bite here.
sort of. Sorry again, apologies. Okay, and then there's a whole load. Okay, so I think you slightly win on that side. And what? There's just a whole load of people who I'm going to be controversial. Either aren't listening or just don't know the answer, right? Kind of don't know.
When you get bitten, it's over, so it doesn't.
Okay, when you get bitten, it's over.
We couldn't go on ChatGPT quick enough with your question.
Okay, fair enough. Okay, so we're coming to an end. So you've all been a wonderful audience, albeit a way more passive audience than I thought FII would be, but that's okay. We're having a ball up here. At least I am. So I have one question that I'm hoping you'll each give like a sentence on before we close, and that is, if you had to predict one major transformation in how emerging markets are financed over the next 5 years, what would it be? Who wants to start? And you got to do it in like 2 sentences.
I would say over 5 years, the securitization market will be introduced to these emerging countries, and they're going to get more efficiency in capital and redistribution of their risk to the broader investor pool.
Okay, and just to follow up on that, is that more linear or is that more S-curve? So when you say more,
yeah,
are we saying
it's going to be linear?
It's going to be linear. So we're just going to keep.
Take time.
We're just going to keep on. So it's not really transformational. It's
it's going to take
gradual
time.
evolution. Okay. What else?
I'll go next. I think in emerging markets in the next 5 years, we're going to see a lot of non-banking financial institutions complementing with banks too. And I do believe there's a lot of role for fintech. Whether it's AI or not is really not relevant. Even mobile payments is fintech. So I think a combination of fintechs, non-banking financial institutions, and the regulators waking up to the importance of this will help a lot.
Okay. It's the blended.
It's the blended, yes.
Collaboration.
Like in India, I would give you one example. There's something called integrated API payments. So every fintech private loan is integrated into the national database of lending. So the system knows what the shadow banking has in terms of credit.
Interesting. India is such an interesting market. We don't have time for it. Okay, Patrick, Wenyi, one sentence. Go on, Wenyi.
Yeah, I would say, some of this has already been said, but I do think the local financing, the local capital aspect of it is very important. And I think thus, whether it's the managers or the kind of productization of what they're investing in becomes very important to push that, right? The institutionalization at the local currency level, I think is very important, but you have to build the right products for that.
Okay, so local institutionalization, productization, I love it. A few more izations. Patrick, take us home.
Sometimes I think a little bit wild, and I think the money is actually just a database of information. It's a storage of information. I think that might be gone.
Okay, that's a really good place to end because I'm not quite sure I understood it and I'm not quite sure where to go with it. So, you know what? I would love to. You're going to have to come up at the end and catch people because I've been given the eye, and if I don't do what they tell me to do, then I don't get invited back. So, thank you all for being a lovely audience, albeit I wanted to get some knowledge from you and you weren't willing to give it. But on the other hand, we had lots of great knowledge from here on the panel. Can I thank you all? Will you join me?
Thank you. Thank you.